Hey everyone, Logan Hertz with Hazeltine LLC. We are continuing our series of interviews with seasoned professionals in the financial industry that have a lot more experience and success than myself. Today, we're excited to turn our attention to real estate. We have with us today Greg Farricielli, who's a very experienced and successful real estate broker and developer. He does a little bit of everything, including, of course, hard money lending, which he does from his HELOCs. He does multifamily apartment syndication. He's got about 80 doors of rentals, and we're super excited to have him with us in the program today. Greg, how are you doing?
I'm doing fantastic. How are you? Thanks for having
Doing
me.
well. Doing well.
Great.
Sure, sure. So the first thing I always like to start with is your why, your backstory. Why real estate? Why do you do what you do?
Great question. Well, there's a couple different reasons. Number one is I can't hold a job. I'm completely unemployable. I've gotten fired from pretty much every type of job that I've had, you know, that I can't hold a job more than a year and a half or so.
You and Robert Kiyosaki, right?
Oh man, I tell you what, it's so, I don't know why that is, but I'm a great employee, but once I learn that I do not have to be an employee is like when I can't. So yeah, my why is mostly like, I like to give back a lot. I work with a lot of nonprofits. I like to give a lot of money away. I like to help a lot of people. And real estate gives me the time and the flexibility and the resources to just really be able to do that.
Excellent, excellent. So tell us a little bit about your I know we said you kind of do a little bit of everything,
Sure.
but for our audience, are there like specific strategies that you really like that you want to share with us that
Sure.
you've succeeded with?
Well, so when people ask me about strategies, it's hard to answer because the strategies really come from what is, the market is bearing at that time. So I can tell you that I love the burst strategy, but I'm going to tell you the burst strategy is the worst thing to do right now because interest rates are so high and you can't really get a lot of bridge debt and stuff like that. It is possible. I'm not saying it's not possible, but that was a great strategy and will be a great strategy again. Right now, my main source of is really just buying undervalued land and then flipping it either to land doing entitlements and then selling to national home builders or, marginal home builders, or hard money lending is a great way to just have some semi-passive income. Of course, my rental properties, so my multifamily and my single family, but I bought all those, 3, 4 years ago. I don't think I bought a rental in two years, except for the apartment building. Other than that, the other strategies I like is really just whatever the market bears. Wholesaling is good now because you don't have to take the risk of doing a flip. I personally don't like to do flips. I don't, it's too much risk for me. I just don't like the small moving parts and, the leverage. And I like to move in and out of things fairly quickly. Like I'd rather just lend on it than do the work and then have to worry about getting it sold and this and that. So that's kind of where I'm at right now. But I've done all of the above in the past. I could talk about, it's up to your audience. I could talk about things that I've done personally to cushion myself for the recession that we're in right now, if you will, and the downturn. And, with the market rate change, we're not able to flip land as quickly. We're not able to get multiple offers and sell your listings and sell your land and sell your houses in a short amount of time. So now it's time to hold and you still have to buy, but you're not able to sell. So you have that money to buy, or investors that want to help you buy stuff, but you're not going to be able to sell it probably year 1 or 2, even maybe. We have some land that probably will end up being 5 or 10 year holds.
Yeah. So you mentioned a burst strategy, and that's interesting because I know one of the strategies that you employ that I'm starting to build more content around is the first lien HELOC strategy. A lot of investors are not aware that you can purchase investment properties using a first lien HELOC, or you can refinance uh, some investment properties into a first lien HELOC. And I've often thought of it it's almost like using a first lien HELOC is sort of like a burst strategy, but without the need to refinance because a HELOC is a two-way street. You can just put money in, pull it out, put money in, pull it out.
Yeah.
How do you use your first lien HELOC? Or do you
I,
have
yeah, I've got a few of them. I have a different take on it. I guess the first thing I want to say is like, not every state allows a first position purchase HELOC. I made that mistake before when the loan officer even told me that they could do it until the day of closing.
wow.
And I've already moved on
Wow.
because So let's talk about, this is probably primarily something that you would do on a primary residence. You get the most leverage. Usually you get, 90% of your, every bank's different, but I got 90% on mine. And you want to always start with your primary residence, right? And a lot of people say, well, I don't want to have debt on my primary, or I have a cheap interest rate. And that's cool. But for me, I was buying my primary cash. So the way I see it is, if I have cash sitting in the bank, right? Let's just pretend I have $1 million in the bank, right? My house is worth 900,000 or 800,000, and I could pay cash for it. That's great. So I'm going to pay $800,000 cash. I have no mortgage, right? But I also don't have my 800K, right? So then I go ahead and I put a first position HELOC on it, and I refinance it out. I get my draw and I pay it back immediately. So basically I got my money, I get funded, I put it back into the bank. So now it's paid off, but I still have access to the funds whenever I want, right? So now that money just could become anything. That's what I like to have for, emergency funds. It could be for buying property. It could be for buying a car. It could be just anything you want, right? And you just goes in and out. You can only use the interest on what you use. So if I take 20 grand out, or take 100 grand out to do a hard money loan or something, then I'm only paying on the interest that I'll pull, right? So it's not like, and it's usually interest only. So you just have to make sure that, that's how I use it. But if people are 9 to 5ers and they're on a fixed income, right? You got to be a little bit more careful, because sometimes the interest rate, if they're so high right now, even though they're interest only, it may not make the most sense right away. So if you could offset your cash, the cash that's in the bank does nothing for me, but now I get the access to the cash, and I'm kind of living for free because I have no payment, but I can still pull the cash, right? And that's how you fully leverage a primary residence and all the cash that you have, 90% of the value of the cash. So if you have 400 grand in the bank, buy yourself $350,000. If you have 500,000 in the bank, or maybe you pull it from a life insurance policy, maybe you pull it from an IRA or whatever, you got to run the numbers to see if it makes sense. So I like to use that as like my cushion, my investment money. And I like to kind of layer things backwards, right? I don't like to be caught in the middle of a storm. So like, you got your cash, and then under that, you got your HELOC. Then under that, you got your life insurance policy. And maybe under that, you even have some credit cards. Like I have like probably 250 grand worth of like open credit cards if I need money. So it's like my cash I like to use my cash first because I don't pay interest on it, right? Go to your HELOCs if you run out of cash or you want to do something else. Well, depending on where you are in your life insurance situation, for me, that's like something that I plan for decades, right? Like my HELOCs are going to take me for the next 10 years, right? And the way I do my life insurance is I amortize it as 7 years instead of 30. So by the time I think 3 years in, so another 4 years, I'll have the full cash value to use. So that'll be another avenue that I could I'll probably use that instead of my HELOCs, because the rate is going to be probably, I think it's 3.5 or 4% or something.
Right. So let me interrupt you for a second. So you're talking about various places to store and access liquidity, which is huge for a real estate investor, but huge for anyone. It's really just a matter maybe of how much liquidity you need and what your specific use case is, but we all need liquidity, right? So you're talking about storing liquidity in cash in a bank, storing liquidity in a first lien HELOC, and against your primary residence, you're going to get the best terms, right? Because it's your primary residence, the lowest risk to the bank, you're going to get the lowest rate, you're going to get the highest loan to value ratio, right? And to your point, it's kind of, it gives you kind of two uses instead of just one. So if you imagine a scenario where I've got $100,000 worth of debt on my house and I've got $100,000 cash in the bank. Well, you wouldn't necessarily want to just pay off your house, because now you lose your $100,000. You have no liquidity. Okay. But if you have a first lien HELOC, now you can do that. You take your $100,000 in cash, pay it into your HELOC. Now you have no debt, but you still have access to 100,000 because it's a HELOC. You can pull the money back out. Right. Now, life insurance, as you mentioned, is similar, but to your point, it's much more of a long-term strategy. The capitalization process in a whole life insurance policy takes time, right? It's very safe. It's very guaranteed. It's liquid. It's tax-free. Plus it gives you that death benefit protection. But what you're doing is you're building equity in the policy. That equity we call cash value. And you can, like a real estate investor, borrow against your policy without interrupting the cash value growth of the policy. And I know this may be all old news to you, Greg, but I don't want to assume that my audience knows what we're talking about
Sure.
when we talk about life insurance. Because when you say life insurance, a lot of people just think of term like, what are you talking about? What is this crazy scheme, right? You know, it's actually a very safe way to access liquidity, and real estate investors like Greg do this all the time. And then you can use those policy loans, borrowing against your policy for anything that you want, right? The beauty of a policy loan is that there are no repayment terms on that loan. You borrow against the cash value in your policy, your cash value keeps earning for you. And on that policy loan, you decide how you want to pay it back. It's totally up to you because the death benefit on the policy guarantees the life. So the life insurance company doesn't require any repayments from you because they know at the very least that death benefit will pay off the loan. Right.
Right. So hindsight, I wish I did this when I was younger because then I would have, obviously you have to have the money to pay all the premiums, right? I would probably want to get one for every member of my family at one, you know, and probably like whoever, like mine would probably amortize in 7 years, like I do mine, and then everybody else can be at third. And then over time, they just all accumulate on top of each other. And then, that's how you kind of become your own bank. You don't need any other banks. You don't need to get approval for loans. You can just you're really set because you have the death benefit, you've got the cash value. And also on the HELOCs, there's people that are like, well, my mortgages, I bought my house in 2020. I paid 300,000 for it. Now it's worth 600,000, but I have a 3.1 rate and I don't want to refinance this to a HELOC. Well, you could do the same thing with the second HELOC too. So if you have 300K in equity and you get, say, 80% of that equity, say that's 400 grand or 200 grand. I mean, you can do the same thing with that 200 grand as you could, but you're going to, if you're just taking out on the equity and you don't have the cash to put in there right away, you're gonna have to just pay the payment, right? Or you could tell the bank not to take a draw. So I would probably tell them not to take a draw, just have it lined up so you don't have to put it in there and just use it when you take a draw. So that's kind of like a good in between that I've seen people use to not have to get rid of their debt because the interest rates, if they're under 6,
What everybody says, Greg, is I don't need the money. Like, yeah, that's the whole point. Secure that debt instrument when times are
100%.
good and you don't need it. Because when you need it, you won't be able to get it.
Well, right. So right now it's really hard. So I used to get them. So I've got a couple of them, and this is a great hack too. It's like, if you want to move every 2 or 3 years, you get one on your primary, then you buy another primary, you do the same thing, so I did it on 2 primaries and a rental. And then I also did it on a piece of land. So back in the day, I have banks I had great relationships with in 2021. They used to give me HELOCs on my land.
Wow.
I only used to get 50 or 60%, but hey, I'll take 50, 60%. I mean, one time I paid 40%, but I still have I'm like, cool, this is all just money that I can pull from when I find a deal. I don't have to ask anybody. So it's like basically pre-approved funded loans that you can just pull from whenever, and you don't have to, wait for a bank approval. So you could pay cash right away, theoretically. All you do is transfer into your checking account and call the bank and do a wire and you're done. I do most of my stuff, like my hard money loans are all same day.
You use a credit card. You could literally use a credit card and spend money from your HELOC.
Well, yeah, you can use, basically a lot of times you'll have to do it to a checking account because if you put if you put like a debit card or anything on the HELOC, there's a lot of money at risk that could get frauded. So I like to put into a checking account. I leave nothing in my checking accounts. My checking accounts are like dry, so like basically it's like, I put all my bills on my credit card, so I earn the points. So let's just say my points on my credit cards are $10,000. Then I automatically transfer it from my HELOC into my checking account, and then I'll pull from my checking account or the credit card from the checking account, basically all the same day. So I'm really not. So if I pay the statement balance off on the credit card, I'm not paying interest on the credit card, and I'm not really interest anywhere.
This is what we call velocity bank. All your money is constantly working for you. It's never sitting. And you're running your expenses through a rewards earning credit card. So you're taking money you're going to spend anyway.
Right.
Now you're getting additional benefits by spending it on a credit card. But of course, you're paying it off, right? So you get the benefits of the credit card. It increases your float, right? And then you're paying it off at the end of the month. So you pay no interest, right?
Right. And then you want to find the right credit cards to do that with. I have a Discover card that gives me 2% on Amazon. I mean, you can get the hotel cards, like whatever you're doing in your life that you use a lot of, find a card that pays you back on all that and then use that as your card.
And by the way, there are other, I'll probably do some content on this, other very little known benefits to credit cards that I've taken advantage of, like extended warranty. I bought appliances using credit cards where the appliance broke after the warranty had expired, but you get extended warranty through American Express. And I was able to get my money back that way. There's additional fraud protection. There's purchase protections. There's
Yep.
even, if you go and rent a car with a credit card, you can get additional insurance coverage, right? There's all kinds of benefits to credit cards that most people are not aware of and don't take advantage of.
Yep.
Um, but if
Sapphire is a massively good one. Hotels, you get free insurance on rentals. Sometimes you get free rentals. You get all the accident protection, and sometimes if the hotel doesn't cancel, sometimes you can get your money back. I take cruises a lot. So like I'll put everything on my cruise card. I'll pay for my cruise, whatever, say 5 grand or whatever on that cruise card. Then I have all the points to use on the cruise and get credits back. So I don't really pay anything while I'm on the cruise.
now, have you utilized policy loans against your life insurance policy yet, or are you still just capitalizing, building the
I'm
cap?
just still capping it just because I wanted to go as fast as possible. Because in the first, while you're capping it, you can be late on your payments, and you could theoretically take some money out of it, but you kind of hurt the speed of the balance that you want, right? So I'm trying
It's a long term, yeah. It's very much a long term strategy, and that is
for sure.
unfortunately what keeps a lot of people away is they just don't have the patience, right? And so they're like, I want money now, 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 now. And it's like, well, then this you probably don't have the patience to do this because it does take time. You can take money out immediately, but you're not going to have 100% liquidity. It takes time to build that. And of course, the beauty of it is, right? Compound interest, that exponential curve gets better every single year.
Yep.
So the beauty of whole life is once you get past that initial capitalization phase, it's all gravy and it starts being a very cash flow efficient tool.
Right.
Um,
So
once
like
you get past those early years.
if you're in real estate like me, and there's times in the market where you're making a ton of cash, that's just going to happen if you're in it long enough. That's the time to do your policy because it gets based on income. So for me, that's why I was able to do it in a 7 years. I pay like 75 grand a year. But if I was making like 150 a year, 200 a year, I wouldn't be able to do that. So while I was making, you know, some showing, paying a lot of taxes, basically, I was able to show a lot of income and get those better terms where I could squeeze it all in at once, basically.
Yeah. And one thing I always recommend to everyone is take out a convertible term policy. So maybe you don't have the cash flow to start a large whole life policy today. Take out a convertible term policy with a good mutually held insurance company that has a competitive policy with an agent that you trust, right? So you lock in that death benefit, right? God forbid something happens to you. We do need life insurance, God forbid, right? And more importantly, you protect your insurability. So now you have optionality, full options, right? So if you're eligible for, let's say, $5 million of death benefit, take out a convertible term policy for $5 million and do it yesterday. And then no matter what happens to your health, you still have the guaranteed right to convert that in whole or in part over time to whole life policies as it makes sense for you, right? But convertible term is not expensive because it's just term and it keeps all your options open, right? It's like having a guaranteed purchase option because no one believes me when I tell them this, Greg. No one believes me. But it is possible that something negative could happen to your health, right? Apparently, it's not possible for all the people I'm talking to. They were all blessed with invincibility, but it is possible, right? So why not lock in your insurability while you're still healthy, right?
Well, yeah, and while you're younger too, for sure, because even like your blood pressure and all your heart rate and all that. I mean, I remember when I was doing mine, like I was like made sure I actually pushed it out like a month, and I worked down because you get a certain perks if your health is a certain way. I don't know exactly how it is, and then
Right.
sometimes like it'll actually give you gym memberships, like, and links to a lot of different things, but your health, you can't, I mean, you could get denied for a policy or you get really bad terms if you're not in good health. So it's not like you're smoking and you're, 100 pounds overweight. You're not going to get the same policy as someone else your age if that's better health. So your health has a lot to do with it. That's why starting
And,
younger,
and
sure.
Yep. And it's something you don't necessarily have control over because it might not even be you.
Right.
It might be a family member. Something
Yep.
happens to the health of a family member that will affect your rate.
Or you get in a car accident or something uncontrollable.
Yep. Yep. Absolutely. But it appears the people I talk to, they're blessed with invincibility. So they don't need these crummy insurance policies. I wish I was like that. But
Dude,
unfortunately, I was not blessed with invincibility because life is just unfair. Life is just unfair. Um, so Greg, this has been great talking with you. Is there anything you want to leave our audience with in closing about real estate, infinite banking, velocity banking, how to tie them all together?
I mean, really, it depends on who you're talking to. I think the people that are on the fence really need to start doing something because the time is the most valuable thing when it comes to any of these things. I would not be able to get my HELOCs if I would have waited till now, even like last year. I would have not been able to get my life insurance policy if I waited a couple more years, at least to the terms I have now. And a lot of that, like people that want to just like, oh, I need money now. I need money now. Well, figure out how to make money now that makes you money later, right? You want to buy money for now for later. So you want to make sure that you figure out ways to have some active income, some passive income, and get yourself in the right situation because, when you get older and you can't work or something like we got storms and all kinds of stuff going on where people are forced out of jobs right now, this is a way to avoid all that.
Yep. And to your point, the most important element in a whole life policy is actually not so much the amount of money you can pay into it. That is part of it, yes. But more important than that is the passage of time because it gets better every single year. So it's better to start a policy earlier, even if you can't put a lot of money into it, because over time that compound interest will start going, right? Of course, you can take on a policy and sort of fund it minimally to keep it in force and then pay more in later, right? There's some flexibility there as well. Um, but I've done analyses and I'll probably do more on the cost of waiting, where it's like if you wait 1 year to take out your policy, the cost to you is 6 figures worth of retirement in, right? If you
Well,
wait
that's not
3 years,
inflation.
yeah, if you wait 3 years, it's easily over 500,000. And this is just with a let's say a $25,000 annual premium for a 35-year-old, right? So don't wait. And of course, also though, it's never too late, right? Because you have that leveraged death benefit, you can't lose. It's not a losing proposition. And you can take out policies on children and grandchildren. So maybe you say, I'm too old. I would disagree, but think about your children and your grandchildren, right?
Wait. Oh yeah, absolutely. I mean, your kids are probably the best options if you have kids and maybe you're not the best help or whatever, but sure. I
Think
mean,
about compound interest over an 80-year period. What that
yeah.
I
I mean,
have some
that's
content coming it might be posted by the time this video gets posted on juvenile policies, and I'll post that in the link below. I mean, it's unreal the leverage you get in the 70th year of a juvenile policy. Imagine you could basically secure your child's retirement if you pay $500 a month into a whole life policy on a newborn. You've secured your child's retirement.
yep.
It's done.
And it's how and you can I mean, it's how you set your families up for legacies, the policies, they don't go away. Then they take the death benefit, you pass away or whatever, then whoever the beneficiary is, they can take that money and keep doing it.
You can set up what's called a dynasty trust. I will include below a link to What Would the Rockefellers Do, a great book by Garrett Gunderson. If you haven't read it, you should. Talking about how the Rockefellers do exactly that. They have whole life policies on each generation, protected by a trust, so that the death benefit proceeds then go into the next series of whole life policies to fund the family bank. And so when they need capital, that capital never leaves the family banking system. It gets borrowed out and paid back in through this continuing process of what we would call the infinite banking.
Yeah, that's what they do. Anybody
So
can do it.
Greg, we really appreciate your time. Thank you for sharing your insights and your story on real estate. And hopefully we can do this again. But thank you so much for your time, Greg. Great chatting with
Thanks
you.
for having me.
All right. Bye-bye.